The US 10-year is trading at 2.37, through 2.3741 right now. Do we get to 3% at the end of 2018?
Not likely. And we were saying don't bet against bonds. So basically a lot of people are saying that curve is spelling trouble for the US economy. We're interpreting that a little bit differently and saying there is an enormous demand for long-duration assets. And I think I've said this on the programme many times. It's a combination of demographics and the fact that baby boomers' DC pot gets to its maximum when they start piling money into bonds has kept the yield curve pretty well behaved. The growth of LDI, both in Europe, UK and US, has done the same thing. So I don't think we should interpret that flattening of the yield curve as a forecast of trouble in the US economy. So don't bet against bonds is one of our key calls in 2018. Now, that said, you could see a little bit of a drift up.
Long bonds, ultra-long bonds?
Long bonds, right. Because I think there will be, obviously, policy action at the short end that's going to continue to put a little bit of pressure on 2 years, maybe. But at the long end, that could be still pretty well behaved. There's a lot of latent demand for duration. I think the game changer would be if people revised up their long-term forecasts for US growth. If that happened, then real yields would rise, people would revise their forecasts, and it'd be a kind of good news, bad news story.
So this is the bit that I don't understand about this US tax story, and I'm trying to get my head around, and it kind of goes more broadly than this as well. So I'm a US CEO. I'm trying to figure out where I'm going to invest some of this money that may be coming down the pike towards me as a result of this tax story. And I'm thinking, kind of, history tells me I should probably, or maybe my bonus structure tells me I should probably invest it into stock. Why would I invest it into capital goods or people when I don't see any sign of inflation coming down the road and I don't see any sign of wage growth which is going to drive the US consumer forward? I don't understand how, as a CEO, I get over that line to make that decision to invest stuff into kit, which ultimately will improve productivity, which will allow the economy to run at a faster rate, which will change the inflation dynamic. Yeah,
sure. So let me try and answer that. It's a complicated question. Firstly, I think many, if not most CEOs, don't have a financial constraint on their ability to invest. The fact that there's repatriation of dollars is actually irrelevant in terms of whether they can invest. Whether they choose to is based on prospects for the global economy. And you're right, wage inflation. So we haven't had that substitution, apart from in hotspots. If you go to a restaurant in San Francisco, maybe you're not going to see people with iPads and less waiters because their minimum wage is creeping up and you can't find labour. At the moment, the Phillips curve is dead. Maybe. I think it's just sleeping. And I think ultimately there will be a creeping up in wage inflation and that will crimp into profits. I think getting ahead of that as a CEO and saying, look, we've got to start that process now, investing in order that we can capitalise on global growth makes an awful lot of sense.